Hello, everyone. Welcome to another episode of Dollar Dialogue. Today, we're going to talk about a very important economical and historical event that has occurred in the past few years, few decades. And this event that we're going to talk about had shaken our world for some time. And it is an event that every economics student studies, everyone knows about because this event is still fresh in our minds. And yes, we're talking about the Great Recession and we're talking about the 2008 financial crisis. And that's our topic of discussion for today. Episode 32, Mortgage-Backed Securities and the 2008 Financial Crisis with Mr. Zayed Karim. Mr. Zayed Karim is a rising middle schooler in our school. He is the youngest guest speaker in the history of Dollar Dialogue, and he is probably one of the most motivated individuals that I've met in my life. He's very much interested in the fields of economics and in the fields of politics, and he has been studying this 2008 financial crisis as a middle schooler for some time now, and he's very much intrigued by these issues, and we're very glad to have him here with us today and to hear his opinions on these issues. And Dollar Dialogue is about giving people their voice, and we're very glad to have Mr. Zayed Karim here with us today. Mr. Zayed Karim, is there anything that you would like to add to the introduction?
Yes. Hello, Don podcast. My name is Zayed Karim. I am a rising middle schooler, and I'm very excited to be in the podcast today. I'm very passionate about finance, and I have dabbled in the stock market with my father in the past. I am currently reading books like Crashed: How a Decade of Financial Crisis Changed the World, to expand my understanding of finance and economics. In my future, I am adamant on becoming a businessman, so very excited to talk about the 2008 financial crisis. Look forward to a fruitful discussion.
Thank you, Mr. Zayed Karim, for that wonderful introduction, and we're very glad to have you here with us today. And let's get right back into our discussion, the 2008 financial crisis and why it happened. So the first thing that everyone knows about is the housing market bubble. And this was caused by excessive lending, which is when banks issued risky loans, and they were also called subprime mortgages to borrowers with poor credit histories. And there were also a lot of speculation. Rising home prices led to speculations with investors and individuals buying properties to flip for profit. And there was also a lot of relaxed lending standards. The mortgage lenders adopted no-doc or low-doc loans, reducing borrower scrutiny. And in fact, I remember in school, Mr. Wilkins was talking about how a house that used to cost only like $50,000 in 2005 rapidly went up, and the price of that house rapidly went up to $80,000 by 2007, 2008. And this shows how much the bubble had expanded, and the bubble was just blowing and growing, and until one day it popped. And let's talk a little bit about the subprime mortgages and the predatory lending. There was also a lot of high-risk borrowers. The subprime mortgages targeted individuals unlikely to sustain payments in the long term. And there were also a lot of adjustable rate mortgages, which are known as ARMs. The borrowers face rising payments after introductory low periods expired. And there's also a lot of predatory practices. The aggressive marketing and deceitful terms trapped borrowers in unaffordable loans. And then there was something that was not introduced during the 2008 but prior to 2008, which was called the mortgage-backed securities, also known as MBS. And the mortgages were bundled and sold to investors as securities. And then there were also the CDOs, also known as collateralized debt obligations. These banks grouped the MBSs into tranches based on risk, hiding subprime exposure in supposedly safe investments. And then there's also the credit default swaps, CDS, and this insurance-like contracts sold against MBS defaults. And the American International Group, also known as the AIG, was a leading seller of CDS and played a pivotal role in the crisis. Moreover, there was also, again, as I've said, excessive leverage by financial institutions. The investment banks significantly introduced leverage to boost profits, making them vulnerable to downturns. And the banks heavily invested in MDS and CDOs, relying on short-term debt to fund long-term assets. And there was also a lot of weak regulatory oversight. There was a lot of deregulations in the 1990s and 2000s. The policies like the repeal of the Glass-Steagall Act of 1999 allowed investment and commercial banks to merge, increasing risk exposure. And there's also a lot of failure to regulate new products. The instruments like CDOs and CDS were poorly understood and unregulated. And agencies such as the SEC failed to monitor leverage and systematic risk effectively. And then there's also agencies like Moody's and S&P, which rated risky securities as AAA to maintain relationship with banks. And there's also a lot of overestimation of MBS safety, which misled investors globally. In addition, there's also a lot of global imbalances and excess liquidity. Post 2001 recession, the Federal Reserve kept interest rates low, spurring borrowing and asset bubbles, and the surplus savings in emerging markets, particularly China, flowed into the US, inflating asset prices. And the investors also pursued high yield but high risk assets such as MBS. And now let's talk about AIG, the American International Group. A lot of people, when they talk about the 2008 financial crisis, and which I find very unfortunate, is that they don't talk about the role of AIG. AIG, I think, in my opinion, is the sole and one of the main causes of the financial crisis, because they were the company that was giving confidence to these investors to buy the CDS and the MBSs. The AIG's role in the financial crisis was somewhat like an insurance agency. The AIG's financial products division issued a large volume of CDS contracts, insuring investors against defaults on CDOs. And these CDS contracts were unregulated and created significant exposure for AIG. And AIG CDS were tied to MBS and CDOs, many of which were underpinned by subprime mortgages. And when subprime mortgage default rose, AIG faced massive payout obligations. And there was also a lot of inadequate collateral reserves. The AIG had significant insufficient reserves to cover the losses from the CDS payouts. And its overconfidence in the housing market stability led to underpricing risk. And there was also a lot of liquidity crisis as counterparties demanded collateral amid declining asset values. AIG's liquidity rapidly evaporated, and the AIG's collapse would have triggered defaults across the financial system due to its interconnected with major banks. And the United States government, after the 2000 financial crisis, injected $182 billion into AIG to prevent its collapse, becoming a majority stakeholder. And this rescue underscored AIG's critical role in exacerbating and amplifying the crisis. And there's also a lot of triggering events that have caused the 2000 financial crisis. The US housing price peaked in 2006 and began falling, leading to widespread mortgage defaults, and the bankruptcy of a major investment bank sparked panic in global financial crisis, which was Lehman Brothers. And the AIG also neared bankruptcy on September 16, 2008, and as it faced a liquidity crisis and required immediate government intervention, and institutions like Bear Stearns and AIG required rescue to prevent global collapse. So these are one of the many causes of the 2000 financial crisis. So what do you think are some of the things that have caused this financial crisis? Mr. Zayed, Karim, Karim, or Arif Malik?
Yeah, Araf, to add on, I'd say, Araf, you gave a really good introduction and you talked very well, so thank you for that. And so I'd say, like, in the early 2000s, the housing market was booming and home prices were skyrocketing and banks started handing out loans like candy, but why? And I'd say it's because they could bundle them into mortgage-backed securities and sell them off, passing the risks to someone else. But it didn't stop there. To make these investments even more appealing, Wall Street created complex products like debt obligations or CDOs, and these were essentially bundles of mortgage-backed securities split into slices or tranches based on risk levels. And here's the problem. Investors trusted the rating agencies, which gave many of these risky securities, and AAA ratings, the highest possible grade, typically reserved for ultra-safe investments. But, spoiler alert, they weren't safe at all. And by 2007, cracks started to show. Subprime borrowers couldn't keep up their mortgage payments, and foreclosures skyrocketed. And remember, these risky loans were baked into mortgage-backed securities with CDOs and CDOs. And as borrowers defaulted, the value of these securities plummeted. And banks and financial institutions, which were heavily invested in MBS and CDOs, suddenly found themselves holding toxic assets that were worth far less than what they had paid for. And the Lehman Brothers, Bear Stearns, and even AIG were hit hard. And in September 2008, I think the Lehman Brothers filed for bankruptcy, triggering a financial panic. So why did this happen? Like, Araf, you had asked for like what went wrong, right? And I'd say it wasn't just one thing. It was a combination of greed, poor regulation, and overconfidence. Like greed because banks were focused on profits more than on ensuring borrowers could repay their loans. And also the poor regulation, like the financial institutions took on massive risks and regulators failed to step in. And also like their overconfidence, like investors investors trusted AAA ratings without fully understanding the risks, and it's like everyone was playing a high stakes game of musical chairs. When the music stopped, weren't enough chairs left for everyone. So yeah. Yes, Zayed, you have your hand raised.
Yes, Mr. Zayed Karim, I see your hand raised. Would you like to add anything?
Yeah, so I think another key factor of that could be the CDOs, collateralized debt obligations. So CDOs were another complex financial product that played a critical role in the crisis. These were investment vehicles that pooled various types of debt, including MBS, auto loans, and corporate bonds. The CDOs were then sliced into tranches or segments, which were sold to investors based on their level of risk. The senior tranches, the safest, were given the highest ratings, while the lower tranches, the riskiest, were sold to investors seeking higher returns. Many of the CDOs were composed of MBS tied to subprime mortgages, which were extremely risky once housing prices started to decline. And another thing could be the credit default swaps, also known as CDS, as AIG and other financial institutions were heavily involved in the sale of CDS, which are essentially just insurance contracts that promise to cover the losses on MBS or CDOs in the event of a default. AIG, for example, sold massive quantities of SDS or mortage-backed securities without properly assessing the scale of risk. When the value of these securities plummeted to rising defaults, AIG was on the hook for billions of dollars in payout money it didn't have. This contributed heavily to the company's collapse and to the wider financial instability. Yeah. So, would any of you like to add on?
Yes, Mr. Zayed Karim, I 100% agree with you. Also, Malik, I see your hand is raised. Would you like to add anything?
Yeah, I think Zayed brought up a very good point, and I would like to applaud him for his nuance into the topic, particularly about the trenches and how it potentially exacerbated the crisis. So, subprime mortgages are the loans that people borrow who have low credit, and the problem with the subprime mortgages was that the mortgage-backed securities consisted of these subprime mortgages that the insurance companies and the banks essentially they just sold and they just pumped it out. And the problem was that most of these subprime mortgages were given to people who were not financially stable. So when inflation hit hard, everyone couldn't pay back, and that is essentially what caused the 2008 financial crisis. But I think it's important to mention as well some of the key players that were involved. I think I agree with Araf that I agree with Araf particularly in the fact that there are a lot of key players in the market. But I would say other than AIG, which Araf has mentioned, I would say other key players also included financial institutions such as the Lehman Brothers, and also not only that, the U.S. Treasury, the Federal Reserve, as well as other credit rating agencies. Particularly, I would like to talk about Ben Bernanke, and we all know Ben Bernanke is the famous Federal Reserve chairman, and as Greenspan's successor, Bernanke had to navigate the unfolding crisis. And Bernanke himself, while I was researching about him, he was a scholar of the Great Depression. So Bernanke implemented aggressive monetary policies, including the slashing of interest rates and initiating quantitative easing to inject liquidity into the financial system. And his leadership was pivotal in calming the market. But critics contend that the Federal Reserve could have done more to prevent this crisis by addressing the housing bubble earlier. As well, and on top of that, I would also like to talk about the U.S. Treasury Secretary Henry Paulson. Paulson was formerly the CEO of Goldman Sachs, and he played a central role in responding to the financial meltdown. Paulson particularly spearheaded the $700 billion troubled asset relief program, the TARP, which was designed to stabilize banks by purchasing the toxic assets after the global meltdown. And while Paulson's quick action is credited with preventing a deeper economic collapse, critics argue that his approach prioritized bailing out Wall Street over helping average Americans. So I would say the problem with the 2008 financial crisis, in essence, was the neglect of the U.S. Treasury, the Federal Reserve, as well as the credit ratings. And interestingly, another important nuance that we must address here is the fact that why did these credit rating agencies such as Moody's, S&P 500, and Fitch, why did they give so high ratings like AAA to mortgage-backed securities and collateralized debt obligations? And the primary reason for that was that these mortgage-backed securities and CDOs, the insurance companies the insurance company that released these products, they actually were customers of these credit rating agencies, and therefore it was sort of like you rub my you rub my shoulder, I'll rub your, sort of that thing, where the insurance companies in essence were loyal customers to the credit rating agencies, and in essence the rating agencies boosted the ratings of these MBS and CDOs. So I think there's also a sort of legal gray area that needs to be addressed.
Yes, Mr. Zayed Karim, I see your hand is raised. Would you like to add anything?
Yeah, so in the book I'm reading, it talks about the 2008 financial crisis, and it says in the second half of 2008, capital flows between rich countries between rich countries plunged from 17 trillion to barely more than 1.5 trillion. No other aggregate in the global economy was affected on anything like this scale or with this suddenness. Yeah, so I think that clearly shows how big the crash was, as the capital flows plunged from 17 trillion to only 1.5 trillion. So yeah, that just shows how big the crash was. Would any of you like to add on anything else?
Yes, I agree with the statements that were given by you, and I think it's very important that we talked about the causes, but I think it's also important that we now talk a little bit more about the effects. I think we touched a little base on that, but I think it's also important to go in depth. So the 2008 financial crisis led to a global economic recession. The GDP contracted a lot. The GDP fell sharply, with advanced economies suffering significant slowdowns, and the US GDP dropped by 4.3% during the recession's worst period, which was between 2007 and 2009. And over 8.7 million jobs were lost in the US by 2010, with employment peaking at 10% in October 2009. And the global employment also spiked, affecting millions, particularly in Europe. And the average global growth fell from 5.1% in 2007 to 2.9% in 2008, and further slowed in 2009. And there was also a lot of massive foreclosures for homes. And I think it's also very important that we as individuals talk about the importance of a home, because homes are where we live in, right? And so a lot of foreclosures of home means that people lost their homes, and over 9 million US homes were foreclosed between 2008 and 2014, and many homeowners face significant negative equity, where mortgages exceeded the value of their homes. Just think about it: the home that you live in, the mortgage on it is $500,000, and the home is worth only $300,000. So you basically paid more money for the home than the value of the home itself. So that's to a common man to common person in Bangladesh, that doesn't make sense. But that's what the situation was like in the US. And the declining houses prices fell 33% from the 2006 peak to 2012, and this undermined consumer wealth and spending power. There was also a lot of bank failures. Over 5,500 US banks failed from 2008 to 2014, with Washington Mutual's failure making the largest in US history. And the banks also tightened lending, leading to a credit crunch that stifled small business and consumer borrowing. And the Lehman Brothers bankruptcy and the Bear Stearns near failure shook confidence. And the insurance giant AIG, again, as I said before, would require a $182 billion bailout. And the US also implemented the Troubled Assets Asset Relief Program, TRAP, or TERP, injecting $700 billion to stabilize the financial system. And the governments also globally provided trillions in bailouts and stimulus packages. And also, there was a lot of quantitative easing QE that went on during this period. The central banks, including the US Federal Reserve, initiated quantitative easing, purchases security to inject liquidity and lower interest rate. And some banks took partial ownership of failing financial institutions like the Royal Bank of Scotland in the UK. And the Dow Jones Industrial Average (DJIA) dropped over 50% from its 2007 peak to March 2009, and the global equity markets lost trillions in market value, and the volatility surged as investors exited and risky assets, moving towards a safe haven investments like U.S. Treasury bonds and gold. And the household wealth in the U.S. also fell by an estimated $13 trillion, and the retirement accounts such as the 401ks lost significant value, jeopardizing financial security for millions. And the income stagnant or declined, pushing more people into poverty globally. And the social safety nets were strained due to increased demand for assistance. And the introduction of the Dodd-Frank Wall Street Reform and the Consumer Protection Act also in the US took place to have stricter regulations. And the base regulation also increased capital requirements and risk management standards globally, and the creation of the Consumer Financial Bureau (CFBP) was done to oversee lending practices. And the Volcker rule also limited property lending and speculative investments by commercial banks. And it also has a lot of impact on the developing economies, including emerging markets suffer from reduced demand for exports and foreign investments, and nations reliant on remittances saw income distributions due to global job losses. And there was also a lot of impact on the European nations. For example, Spain, Greece, and other Eurozone economies face severe debt challenges due to reduced growth and bank failures. So there were a lot of impacts on the global economy due to the 2008 financial crisis. But what do you think were the biggest impacts, and what are some of the other impacts that happened due to the 2008 financial crisis? Mr. Zayed Karim, Mr. Shazib Karim, or Mr. Arif Malik?
Yeah, Araf. So like you talked about, you had a really close look on the U.S. economy, and which I totally agree. And then you also talked about how you asked about how it affected other economies globally too, right? So I'd say that yeah, the 2008 financial crisis wasn't just a U.S. problem; it became a global economic catastrophe. And to understand its full impact, we can like look at examples, we can look at numbers and stuff. So in the US, GDP contracted sharply, with the economy shrinking by 4.3%. And from late 2007 to mid 2009, marking the deepest recession since the Great Depression. Millions of Americans lost their jobs, pushing unemployment to 10% by October 2009. But you know, the shockwaves didn't stop there. The global economy, deeply interconnected through trade and finance, took a significant hit. Europe was particularly vulnerable. Countries like Ireland, Spain, and Greece experienced severe recessions, driven by their own housing bubbles and high levels of debt. And emerging markets like China and India, which had been growing rapidly, saw slower growth as global demand plummeted, and trade volumes fell dramatically, with world trade shrinking by 12% in 2009 alone. And you know, the US may have been the epicenter of the crisis, but the ripple effects were felt across the globe. And to break it down, in Europe specifically, the crisis exposed deep flaws in the Eurozone's financial system. Countries like Greece, Portugal, and Italy were specifically hit hard, leading to a sovereign debt crisis that dominated headlines for years. Greece, in particular, needed multiple bailouts from the EU and the International Monetary Fund, aka IMF. And there's also China, which had been experiencing double-digit GDP growth, but they ended up seeing their economy, their economy's growth started to slow down as demand for its exports dried up. In response, the Chinese government launched a massive $586 billion stimulus package to boost infrastructure and domestic consumption. And this helped stabilize its growth, but also contributed to a surge in debt that China is still grappling with today. And we can also look at the developing nations. Countries dependent on commodities like oil and metals suffered as global demand and prices plummeted. For instance, oil exporting nations like Russia and Venezuela faced economic turmoil, with Venezuela's GDP shrinking significantly and contributing to its ongoing economic crisis.
Yes, Mr. Zayed Karim, I see your hand is raised. Would you like to add anything?
Yeah, so talking about it, how it affected Europe's, like European banks, like their counterparts in the U.S., had substantial exposure to subprime mortgages, MBS, and other complex financial products tied to the housing bubble. Major institutions such as Deutsche Bank, UBS, and Royal Bank of Scotland had heavily invested in these high-risk assets. When the value of these assets plummeted, European banks faced significant losses, leading to a liquidity crisis. The crisis forced many European governments to intervene and bail out their banks. Countries like UK, Ireland, and Belgium were forced to nationalize or provide emergency funds to failing banks. For example, in Ireland, the government took control of Anglo-Irish Bank and other financial institutions. Similarly, Dexia, a Belgian French bank, required a bailout after its exposure to subprime debt led to significant losses. The collapse of financial institutions and the loss of confidence in the banking system led to severe credit crunch across Europe. Banks became unwilling to lend even to each other, which froze the credit markets. This made it extremely difficult for businesses to get financing, and households found it even harder to secure loans or mortgages. In turn, this exacerbated the economic downturn as economic activity slowly significantly as activity slowed significantly. There was also a lot of negative growth across Europe as financial institutions faltered. European economies fell into recession. The Eurozone, which comprises 19 European countries that use the euro, contracted sharply. According to the European Commission, the EU economy shrank by about 4% in 2009. The UK economy contracted by 4.2%, and countries like Germany, France, and Italy faced significant declines in GDP. Exports, industrial production, and consumer spending all took a hit. So yeah, would any of you like to add on to what I just said?
Mr. Arif Malik, I see your hand is raised. Would you also like to add anything?
Yeah. Apologies, the mic wasn't turning on. Yeah, I would agree with what you guys said, and I would also like to add on that the 2008 financial crisis also had, other than the housing prices being plummeted and showing how risky the financial institutions were, I would like to talk about the immediate response and the long-term structural reforms that took place. So immediately, central banks around the world slashed interest rates and injected liquidity into the banking system through various forms of quantitative easing. And this was aimed at lowering the borrowing cost and stabilizing the financial markets. And fiscal policy wise, I think the government also implemented stimulus packages to expand the gross domestic product and to offset the decline in the private sector demand. This is a Keynesian approach, as many of you viewers might know, and this was intended to boost the spending investment through government intervention. Additionally, the bailouts were given, and these bailouts were essentially a lifeline given to the banks, so none of the banks would go bankrupt, because essentially if the bailouts were not given by the US government, the US, as we know, as the world's largest economy today, would not hold that title. And long-term wise, the Dodd-Frank Act was established in the US, and these regulations were designed to increase the bank capital requirements, improve financial management, and enhance transparency. Additionally, there were some macroprudential policies to address the risk arising from interactions and the broader capital market system. Also, I would like to talk about something that I think needs to be addressed when we are talking about the 2008 financial crisis, and that is about the fractional reserve banking in the U.S. So, in the U.S., fractional reserve banking is basically when we put $100 in the bank. People often assume that that $100 stays in the bank, but that's not the case. In the U.S. and other capitalist societies around the world, that $100, the banks only keep $10 or $20, and the rest of the money is given to other people as loans. And these loans are helpful because the people pay it back with interest rates. So the bank gains a lot, and they also provide us the interest rates for keeping our money at the bank. And the problem with the US is that many of the banks, their fractional reserve rates are very, very low compared to banks in South Asia. And I've realized this. And and this is a double-edged sword. One of the pros of this is the fact that there's more money in the economy. There's more money circulating in the economy, so more people can buy using loans, and that stimulates the gross domestic product, which is why US has such a high GDP. On the other hand, this goes on to show when stuff like 2008 occurs, the banks, they essentially have no money in their vault because they don't keep any money, they just loan everything out. So I think the fractional reserve banking system is also something that is prudent to address in this case. And also I would like to talk about the lessons that we learned from the 2008 financial crisis, because I don't think the many countries around the world learned their lessons. Because in Greece, for example, the austerity measures were not particularly helpful, and also in the 2020 global pandemic, the US also saw a global recession. But I think the Biden administration, one thing that they were smart enough to do was the fact that they gave stimulus checks to people in order to stimulate the economy. This is another Keynesian approach, and I think this stimulus checks, I think the Biden administration early on understood the stock market being hit and how it could have a ripple effect in the economy. But I think in the 2008, the government wasn't involved, the Fed wasn't involved. No one really understood what was going on. And for the viewers out there, I would also recommend the movie Big Short, which truly shows the level to which the level of neglect which the US government had. So I think the lesson learned from the 2008 financial crisis would be, don't underestimate the impacts of crisis, whether it be in any sector, because the 2008 didn't start from stock market, it started from real estate. But from real estate, it went on to stock market, and essentially from US, rest of the world. So yeah, that's my take on it.
Yeah, so what do you think, Shazib Karim, about Arif's take on it, and also about Zayed Karim's information on the recent effects of the effects of the 2008 financial crisis?
Yeah, I mean, they both made some really interesting comments, and I'd agree with both of them. Like, before they both spoke, I talked about how the financial crisis impacted other countries, specifically in Europe, and how Greece took a massive hit. But I think like GDP, GDP was a massive factor, and like how GDP metrics told the story is an interesting thing to talk about, because GDP became one of the most talked about metrics during and after the crisis. And in the US, quarterly GDP reports were scrutinized to gauge the health of the economy, but GDP doesn't tell the whole story. For example, while GDP started to recover by mid 2009, it masked the uneven recovery across sectors, and Wall Street bounced back quickly, and thanks to bailouts and Federal Reserve policies. Whereas meanwhile, Main Street, the everyday economy of jobs, wages, and small businesses, lagged behind. And globally, the crisis revealed the vulnerabilities of relying too heavily on interconnected financial markets, and advanced economies faced years of slow growth, while emerging economies became more cautious about integrating into global markets.
Thank you, Mr. Shazib Karim, Mr. Zayed Karim, and Mr. Arif Malik for all the opinions that have been provided. Now, I think we should also talk about a little bit, since we're people from Bangladesh, we should also talk about the impact of the 2008 financial crisis on developing countries. And developing countries, I think, faced a lot of declining demand for exports, particularly raw materials and manufactured goods, as advanced economies enter recessions. And the commodity exporting nations, such as those in Africa and Latin America, experience price collapses in oil, metals, and agriculture products. For example, the oil prices plummeted from $147 per barrel in 2008 to around $40 by early 2009. And many developing countries heavily relied on the trade with the US, and Europe saw sharp GDP slowdowns. And the sub-Saharan growth slowed from 6.5% in 2007 to 2.8% in 2009. And there's also a lot of drop in foreign direct investment, FDIs. The global uncertainty and risk aversion caused FDI to decline, stalling infrastructure and development projects. And the FDI flows to developing countries dropped by nearly 39% in 2009. And the global investors also withdrew capital from emerging markets, causing currency devaluations and financial instability. And many developing countries also face increased borrowing costs as risk premiums soared. And also a lot of emerging market equity indices fell sharply, eroding wealth and investor confidence. And the MCSI emerging market index dropped by over 50% in 2008. And the global slowdown led to a sharp decline in commodity prices, hitting resource dependent economies hard. And the Brazil and Russia, major exporters of agriculture products and oil, experienced severe contractions. And price stability disrupted government revenues in the resource dependent nations, complicating fiscal planning and public spending. And there's also a lot of decline in global trade volume. The world trade volume fell by 12% in 2009, the world's steepest contraction since World War II. And the export relying economies, such as those in East Asia, suffered reduced industrial production and layoffs. And also, there's also a lot of remittance inflows to developing countries, which dropped as migrant workers in developed nations lost jobs or faced wage cuts. For example, the remittances to Mexico, which relies heavily on US workers, fell by approximately 16% in 2009. And families dependent on remittances faced declining purchasing power, increasing poverty, and reduced consumption in local economies. So, what do you think are some of the other effects on the developing countries as a result of the 2008 financial crisis? Mr. Zayed Karim, Mr. Shazib Karim, or Mr. Arif Malik? Mr. Arif Malik, I see your hand is raised. Would you like to add anything?
Yeah, Raf, I think that you brought up a very good point. And additionally, I would like to talk about something that hasn't been addressed here, particularly regarding the developing countries and how it affected how the 2008 financial crisis affected the developing countries. First, I would like to talk about the economy of the developing countries, because majority of the less economically developed countries, LEDCs, which Bangladesh was during the 2008 financial crisis, and other countries in the region, South Asia predominantly, many of these developing countries were export oriented, primary commodities, which makes them vulnerable to price shocks and global economic turndowns. And on top of that, many of these countries have inadequate infrastructure and transportation, telecommunication, water supply, and energy, which all of which hampers the economic growth and development. And I think the 2008 financial crisis was really TKO to the systems, because it caused many of the countries in South Asia to have ripple effects, to have adverse ripple effects. And additionally, I would like to talk about the fact that the South Asian economies, many of these countries don't have proper legal systems. And countries like the US, countries like organizations like the European Union, all of these places, they have a very strong government, they have a very strong legal system, which is why if the government wants to implement something, for example, stimulus boost in the GDP, they can implement it. But in countries like Bangladesh, in countries like India or Pakistan or even Bhutan, that is not an option, because no matter what the government wants, ultimately the system is so much the system is essentially in shambles. The bureaucratic red tape exists everywhere, but in places like South Asia, the bureaucratic red tape is nothing compared to other regions in the world. So based on that, I would say that it's important to understand that South Asia was predominantly affected by it. And also, I think one of the reasons, one of the other reasons why South Asia was affected by the 2008 financial crisis is because of the foreign direct investment, the FDI. I know for a fact that Bangladesh at that time was heavily reliant on FDI. And when that FDI stopped coming true because of the 2008 financial crisis, Bangladesh really took the impact of that. And FDI is important because export-oriented economies there we needed, and especially developing countries, we are not as rich, and I think that really took a toll. And additionally, I would like to talk about Africa, because Africa often gets left out in the grand scheme of things when we are talking about 2008 financial crisis. Africa has 54 countries. It's one of the largest continents on planet Earth, and Africa itself was challenged by the 2008 financial crisis. Particularly, I would say that Sub-Saharan Africa and West Africa predominantly were affected. And like South Asia, there were reduced foreign direct investment, and also Africa is a gold mine, literally and metaphorically. There's so many gold mines, there's so many commodity there, and a decline in the commodity prices really affected the African economy. So what do you guys think? Would you say the 2008 financial crisis, how would you say its impact how would you say like its event really impacted the South Asian subcontinent, or even Africa or other developing countries?
Mr. Shazib Karim, I see your hand is raised. My apologies, my sincere apologies. Mr. Zayed Karim, I see your hand is raised. Would you like to add anything?
Yeah, so the global financial crisis played a role in exacerbating the economic and political grievances that contributed to the Arab Spring uprisings starting in 2010. Economic hardship, youth unemployment, rising food prices, and dissatisfaction with political elites were key drivers of protests in countries like Tunisia, Egypt, and Libya. And even in Latin America, several Latin American countries such as Argentina and Venezuela, the economic downturn combined with rising social inequality and political corruption led to large-scale protests and political turmoil. So yeah.
Yeah, and I think to add on, I'd agree. And we're on the topic of developing countries. So, particularly developing countries, particularly those dependent on exports to advanced economies, saw a sharp decline in demand. For example, countries like Bangladesh, the countries like Bangladesh where we're from, which rely heavily on textile and garment exports, faced shrinking orders as consumers in the US and Europe cut back on spending. And similarly, commodity exporting countries like Brazil, Nigeria, and Chile were hit hard as global prices for oil, metals, and agricultural goods plummeted. And this reduced their export revenue, widened trade deficits, and strained public budgets. And in times of economic uncertainty, investors tend to pull their money out of riskier markets. And this was evident during the crisis as foreign direct investment, aka FDI, in developing countries dropped sharply. For instance, India and Vietnam, emerging hubs for manufacturing and tech, saw a slowdown in investments, delaying critical infrastructure projects. And also, many developing countries depend on remittances sent by citizens working abroad. As job losses mounted in developing countries, the remittance flow shrank. For example, nations like the Philippines, Mexico, and El Salvador as well experienced significant drops in these vital income streams, hurting millions of households. And to cushion the economic blow, many developing countries borrowed heavily, and this increased their debt burdens, making them more vulnerable to future crises. And sub-Saharan African and South Asia, already grappling with high poverty levels, faced even greater challenges in surviving this debt. So I would like to ask you guys a question. Since we were talking about Bangladesh, I would like to ask you a question about that, and specifically maybe our guest speakers, you can answer this. So my question to you is, how did falling export demand impact economies like Bangladesh, which are heavily reliant on specific industries like textiles?
Falling export demand during the 2008 financial crisis had a profound impact on economies like Bangladesh, where the garments and textile industries are the backbone of the economy. The primary effects were decline in export revenue. The crisis caused a sharp contraction in consumer spending in major markets like the US and Europe, which are the largest importers of Bangladeshi garments. Orders from international buyers dropped significantly, leading to a reduction in export revenues for Bangladesh, where the textile industry accounts for over 80% of export earnings. This was a major economic blow. Another factor is factory closures and job losses. Many factories were forced to shut down or scale back production due to reduced orders. This led to widespread job losses, particularly among women, who make up a significant portion of the garment sector workforce. The resulting unemployment further strained households already struggling with rising living costs. Social impact. The crisis exacerbated social challenges. Families dependent on factory incomes faced financial insecurity, leading to increased child labor as households sought additional sources of income. Education rates also suffered as families prioritized immediate survival over long-term investment in schooling. The government and garment industry leaders faced immense pressure to retain buyers. Some factories were responded by cutting wages or delaying payments, sparking labor unrest. At the time, the crisis underscored the need for Bangladesh to diversify its economy and reduce over reliance on the garment sector. While global demand eventually rebounded, it took years for Bangladesh's garment industry to fully recover. The crisis highlighted the vulnerabilities of export dependent economies and the need for strategies to withstand external shocks. In summary, the fall in export demand not only disrupted Bangladesh's economy, but also exposed the risk of heavy reliance on a single sector, emphasizing the importance of economic diversification and stronger social safety nets. Yeah. So would any
Thank
of
you,
you?
Thank you, Mr. Zayed Karim, for the wonderful response. And I also want to talk a little about the things that you said about the Arab Spring. And I think no one in the world, whenever they talk about the 2000 financial crisis, I think very few in the people in the world talk about the Arab Spring. But I think you have highlighted a very, very one of the most important things in the world that indirectly was caused by the 2000 financial crisis, but many people don't talk about it. And Mr. Zayed Karim, and thank you so much for talking about it. The Arab Spring, and the Arab Spring is something that the effects of the Arab Spring, the people in the Arab world are still feeling it right now. The Syrian civil war, the situation in Libya, the situation in Yemen, the situation in Egypt, the situation in these countries, they're still suffering from what happened in the Arab Spring. In the Arab Spring, for those of our viewers who don't know what it was basically uprising against the dictatorial rule in many of the Arab countries, such as in Syria, such as in Libya, and such as in Tunisia, as Mr. Zayed Karim has highlighted. And what happened was that these people started protesting and they toppled the government. But the thing was that the government, yes, they were toppled, but the people that replaced the dictatorial governments were also dictatorial themselves. And for this reason, they again started their dictatorial rule. And for this reason, the people in the Arab world, even though they toppled a dictator, they replaced it with another dictator, because that's how it worked. That's how it happened, unfortunately. And in Syria, which was also one of the most unfortunate countries, in my opinion, what Bashar al-Assad did, and fortunately he's gone from power right now, but Bashar al-Assad basically fired on people, he killed people for uprising, and I think he did chemical attacks. He killed basically entire towns and their villages, wiped them out because they protested against him. So the Arab Spring was, I think, in a way indirectly caused by the 2000 financial crisis. And Mr. Zayed Karim, thank you so much for bringing it up. And I think that many MENA economics, which is Middle East and North Africa, particularly oil importing nations like Tunisia and Egypt, suffered reduced exports and investment inflows, and the global trade contraction from the crisis negatively impacted industries such as tourism and manufacturing, and the already high youth unemployment in the Arab world worsened as the economic growth slowed, and the youth unemployment in Egypt exceeded 30%, with limited job opportunities creation post-crisis. And the financial crisis and the subsequent speculation in commodities drove up global prices. And in 2008 to 2010, global food crisis saw wheat and rice prices rise significantly, hurting the lower income population in MENA. And the Egypt also faced bread shortages, leading to public frustration as food costs consume a significant share of household income. And the oil price fluctuations impacted both oil exporting and importing nations. And while exporters like Libya benefited initially, importing nations like Tunisia also faced a high energy cost. And the remittance inflows from workers in Europe and the Gulf states declined due to job losses in those regions. And in Egypt, remittances, a critical source of household income, dropped during the global recession. And one of the in Egypt, as for those of you who might not be aware, in Egypt, the dictator, the president of Egypt, I think he was Hosni Mubarak. He was toppled because of the during the Arab Spring, and he was replaced with I think with another person. I think it was Morsi, and then there were a lot of then there was another coup d'état. Then again, another member of the military. I think Al Sisi now he's in power, and there was also a lot of erosion of the middle class stability. For example, the job losses and the inflation worsen, inequality pushing the middle class towards poverty, and the rising cost of living combined with stagnant wages amplified, and the perception of government corruption and the economic management grew as wealth disparities widened, and the economic downturns exposed inequities in how public resources were allocated, and the high unemployment and the low wages and the inflation led to widespread dissatisfaction with economic conditions, and the citizens felt abandoned by governments that failed to provide jobs or basic services during the challenging times. And the urban areas, particularly among youth and the educated populations, became hotbeds for protests as economic despair combined with limited political freedoms. And the governments in MENA also maintained control through repression rather than addressing the rising economic challenges. And the lack of accountability also fuels anger towards ruling elites. And also the high food price and the fuel prices sparked riots and protests in the various countries before the Arab Spring. And in Egypt, in 2008, and in Tunisia, 2010, protests broke over bread shortages and rising costs. So as we can see, one of the indirect causes of the 2000 financial crisis was the Arab Spring, and the Arab Spring is one of the most unfortunate things that happened. And not the thing about the Arab Spring, which was unfortunate in my opinion, is the amount of people that were killed. The dictators were toppled. I think that was a good outcome of the Arab Spring. But to topple the dictators, thousands and thousands of people were killed, and thousands of children were murdered, and thousands of people lost their lives, they lost their homes. So a lot of bad things happened during that time. And so, what do you think? What do you think were some of the causes, the effects of the 2000 financial crisis that we don't think about, but this is something that Mr. Zayed has highlighted, which is the Arab Spring? What are some of the unknown causes, like not unknown, but the causes that are not talked about, the effects that are not talked about due to the 2000 financial crisis? Mr. Zayed Karim, Mr. Shazib Karim, or Arif Malik?
Yeah, Araf. I think there are a lot of nuances, and we can look at the gray area in this. So I think one part which was really affected, which had like some really externalities and unintended effects, would be, I'd say, the delayed careers and the lost generation. Like, if you look at the youth and unemployment, the many young people who graduated during or just after the crisis entered one of the worst job markets in decades. And this phenomenon led to the term lost generation, as graduates were forced to take lower paying jobs or remain unemployed, delaying their career progression and financial independence. And research shows that entering the workforce during a recession can permanently reduce lifetime earnings, as individuals start at lower wages and find it difficult to catch up, you know. And then another thing is also the other stuff, like the housing market distortions, and there was a shift to renting. Like, foreclosures and tighter credit markets pushed millions out of home ownership, leading to a surge in demand for rental properties, and this caused rental prices to rise significantly in many cities. And there were also some abandoned neighborhoods as well. Like, in areas hit hardest by foreclosures, homes were abandoned, leading to urban decay and rising crime rates and declining property values for remaining residents. And of course, we can also talk about the global power shifts as well. Like, while advanced economies were grappling with recession, China kind of rebounded quickly thanks to its massive stimulus package, and this allowed it to solidify its position as a major global economic power. And the crisis diminished the US's reputation as a global financial leader, and countries began questioning the reliability of a dollar-dominated financial system, contributing to debates about de-dollarization. And there were cultural shifts as well, because the crisis reshaped consumer behavior, with many people prioritizing saving over spending. And this gave rise to movements like minimalism and the tiny house trend. And, pop culture reflected this shift, with movies like The Big Short and documentaries like Inside Job critiquing Wall Street's role in the crisis. And these narratives cemented a cultural skepticism towards high finance. And also, while stock markets and corporate profits rebounded quickly, wages for ordinary workers stagnated, exacerbating wealth inequality. Only the top 1% benefited disproportionality from asset price recovery, and budget cuts in public education systems during the recession disproportionality affected low income communities, limiting access to quality education and upward mobility. Yeah.
Yes, Mr. Zayed Karim, I see your hand is raised. Would you like to add anything?
Yeah, so the financial crisis did not just have economic repercussions, it profoundly impacted the political landscape in many countries. From policy shifts to increased political polarization, the financial crisis triggered a range of responses that reshaped political systems, governance structures, and global power dynamics. Like the populist movements, the economic turmoil created by the financial crisis sparked a rising tide of populism in many countries, particularly in the West. Disillusionment with traditional political elites and economic hardships led to a demand for leaders who promised to represent the people against a perceived corrupt establishment. This movement was multi-faced, encompassing both left-wing and right-wing populism. In countries like Greece and Spain, economic suffering led to the rise of left-wing populists such as Syriza and Podemos. These parties criticized austerity measures, called for increased public spending, and promised to address inequality and social welfare. On the right, parties such as UKIP in the United Kingdom, the National Front in France, and Jobbik in Hungary capitalized on national sentiment, anti-immigration rhetoric, and criticism of the European Union. The Brexit referendum in 2016, which resulted in UK's decision to leave the EU, was a direct consequence of populist politics, driven by resentment toward globalization, immigration, and perceived political elites. Donald Trump's election during 2016, it's a clear example of populist rhetoric capitalization on the economic frustrations of large swaths of the electorate. Trump's message resonated with voters who felt like they were behind by the financial system, with slogans like "Make America Great Again," appealing to those who saw their job security, wages, and quality of life stagnate or decline. So yeah, would any of you guys like to add more to that?
Yes, Malik, I see your hand is raised also. Would you like to add anything?
I would like to. I agree with what you guys said, and also I'd like to talk about some of the unheard and lesser discussed impacts of the 2008 financial crisis. Particularly, I would like to talk about the global political shifts that occurred. I think Zayed touched based on this. I would say like the global insecurity and the dissatisfaction with the status quo post-crisis fueled populist movements and skepticism towards globalization and multinational agreements, and this was evident in the US elections. And I would say some of the consequences of these movements was more enhanced nationalism and skepticism of international trade agreements and strict immigration policies. Additionally, I would say this definitely led to more polarization in the labor market. The crisis unequivocally accelerated trends toward labor market polarization in many developed countries, where there was a growth in high skill, high wage jobs and low skill, low wage jobs, but a decline in the middle skill, middle wage jobs. And this shift has been partly attributed to technological changes and globalization, but the crisis intensified these changes by hastening the decline of industries such as manufacturing in developed countries. Additionally, I would say that environmentally wise, something that is not talked about. Environmentally wise, the 2008 financial crisis impacted to some extent as well, because in the immediate aftermath of the crisis, many governments and businesses curtailed their investment in environmental projects due to budget constraints and shifting priorities towards economic recovery. Initiatives for renewable energy, conservation, and sustainable infrastructure faced funding cuts and delays. However, I would say as part of the economic recovery efforts, several countries incorporated green initiatives into their stimulus package. For example, the U.S. American Recovery and the Reinvestment Act of '09 included a significant funding for renewable energy projects and energy efficiency improvements. And post crisis, there was no notable shift in companies viewing their role in society. For example, the ESG scores and corporate social responsibility, which is something that is very important nowadays. And corporate social responsibility is often something that people now consider when looking into companies. However, I would say after the immediate impact of 2008 crisis, people sort of stopped caring about it for a while, because at that time it wasn't, to people, not that relevant compared to other things such as keeping the economy alive.
Thank you, Mr. Arif Malik. Mr. Shazib Karim, I see your hand is also raised. Would you like to add anything? My sincere apologies. It was Mr. Zayed Karim. Mr. Zayed Karim, I see your hand is raised. Would you like to add anything?
Yeah, thank you. So now I think we should talk about the aftermath and how the countries and how their economy recovered. The recovery from the 2008 crisis was very slow and very uneven across the world. Advanced economies like US and Europe struggled with high unemployment, stagnant wages, and slow GDP growth for years after the crisis, while China and some other emerging economies experienced rapid recovery. Many developed nations faced years of economic sluggishness. The US economy eventually recovered, but at a slower than expected pace. While GDP growth was resumed and the unemployment rate remained high for several years, the housing market rebounded more quickly due to government intervention, but income inequality worsened, and the recovery was not equally shared across different regions and demographics. The European Union, particularly the Eurozone, faced a sovereign debt crisis, especially in countries like Greece and Spain, Portugal, that compounded the effects of 2008 recession. The Eurozone's recovery was hampered by stringent austerity measures, which were imposed as conditions for bailout packages. These measures led to widespread public protest and social unrest, especially in Southern Europe. Many developing countries faced serious economic setbacks, but Asia recovered more swiftly, driven by domestic demand, government stimulus, and the continued growth of manufactured and exports. However, some countries in Africa, Latin America, and Eastern Europe remained vulnerable to external shock and struggled to regain momentum. So yeah, would you guys like to add more to that?
I think I agree 100% with Mr. Zayed Karim and the opinions that you have shared, that the effects of the 2000 financial crisis was felt across the continent, into Europe and into the European continent and into other parts of the world as well. And I think it's very important that we understand the effects of the 2000 financial crisis to understand why it really happened. And in my opinion, for it to be prevented, I think that there should be a regulatory efforts put in place. And I think that the US government did it afterwards. And I think one of the most simplest ways this financial crisis and this crisis has affected millions of people around the world, this could have been avoided by easily making sure that the US banks didn't provide loans to subprime mortgages. They looked at people before providing loans. They looked at the people's financial statements before providing loans. And in other words, they should have made sure that if they're providing loan to someone to buy a house, they should be able to repay it. And that's, I think, what the US bank should have done. And they shouldn't have taken that debt and sold it and made it more complicated to make it, quote unquote, look safer. So I think that's what should have been done. And I think that the SEC should have tried to prevent it in this manner. Is that what do you think should have been done? Like, how do you think the 2000 financial crisis could have been prevented? Mr. Shazib Karim, or Mr. Zayed Karim, or Mr. Arif Malik? Mr. Arif Malik, I see your hand is raised. Would you like to add something? I think your mic is not turning on. My apologies, it was Mr. Shazib Karim. Mr. Shazib Karim, I see your hand is raised.
Yeah, no worries, Araf. So, yeah, Araf, you brought up, like, we've been talking about the crisis, but then now we can also talk about how it can be prevented, right? And you brought up a very interesting point. So, yeah, and I also agree with your insights as well, Araf. But I think another part that we can talk about is, just having stronger regulation of financial products. Like the complexity and risk of mortgage-backed securities and collateralized debt obligations, or CDOs, were poorly understood, even by many investors. Regulators should have required greater transparency about the underlying loans in these products, such as borrower creditworthiness and default risk. And the crisis was fueled by the explosion of subprime loans, mortgages issued to borrowers with poor credit histories. And if banks had adhered to stricter lending standards and been subject to regular audits to prevent predatory lending, the volume of toxic loans would have been much more lower, I'd say. And also, policymakers could have acted sooner as well to cool the overheated housing market. Measures like raising interest rates, increasing down payment requirements, or implementing stricter mortgage approval standards would have slowed the unsustainable rise in home prices. And many buyers were speculating on home prices, purchasing properties not to live in but to sell for profit. Introducing taxes on speculative real estate transactions could have discouraged this behavior and reduced the housing bubble's growth. And also, the crisis, it was we talked about how it was global, right? But financial regulations varied widely between countries, and better coordination among governments and central banks through organizations like the G20 could have ensured that all major economies implemented safeguards to prevent this from getting any worse. And for developing countries specifically, stronger capital controls could have prevented rapid inflows and outflows of foreign investment, which exacerbated the impact of the crisis in these regions.
Yes, I think I agree with Mr. Shazib Karim's statements, and I think that brings us to the conclusion of today's episode. And based on the discussion we had, I think we can draw the conclusion that the 2000 financial crisis was one of the most significant economic upheavals in modern history, with far-reaching implications across global and regional systems. Originating in the U.S. housing market, are fueled by risky financial practices such as those involving subprime mortgages, credit default swaps, and over-leverage by financial institutions like AIG. The crisis rippled through the interconnected global economy. It also exposed systematic vulnerabilities in banking and led to global recessions and triggered widespread economic and socioeconomic disruptions for the developing world, particularly the Middle East and North Africa. The effects of the crisis even led to the revolutions that have occurred in these places, and the interrelation between financial crisis and the regional political dynamics and the social unrest highlights the interconnected nature of today's world. And economic events in one region can set off a chain of unintended consequences affecting distant economies and trigger socioeconomic transformations, particularly if those economic events if they happen in like the major economies of the world, like the US. And ultimately, 2000 financial crisis and its connection to the many of the effects that was felt not only in the US but also in other countries around the world underline the critical importance of building resilient economic and political systems that can withstand external shocks while addressing underlying vulnerabilities. So is that a conclusion that all of you would agree with, Mr. Shazib Karim, Mr. Zayed Karim, and Mr. Arif Malik?
Yeah, I would agree with that.
Yeah, I also agree with what you just said.
Yeah, I concur too.
Thank you everyone for your agreements, and I think that brings us to the end of today's episode 32, mortgage-backed securities and the 2000 financial crisis with Mr. Zayed Karim. Mr. Zayed Karim, thank you so much for coming to today's podcast and for sharing your invaluable opinions. I think your inputs, especially in looking at the nuances in the effects of the 2000 financial crisis, was very helpful. Again, thank you, Mr. Zayed Karim, for coming into this episode, and we really enjoyed your input, and we really enjoyed having a discussion with you today. And is there anything that you would like to say? Are there any final words that you would like to say before we depart for today?
Yeah, thank you for having me on this podcast. It was a great experience, and yeah, I just love how it talks about the economy, and yeah, how informative it is. And yeah, thank you so much for having me here.
Thank you, Mr. Zayed Karim, for that wonderful concluding statement. And again, that brings to the ending and the conclusion of episode 32, which was about mortgage-backed securities and the 2008 financial crisis with Mr. Zayed Karim. Thank you to the audience for listening into today's podcast. And we really hope that you enjoyed our discussion. And we hope to see you next week with another very interesting topic with another very interesting guest speaker. Thank you and goodbye for now.